Something I was hearing over and over when I first started investing was buy the dip, but I didn't really know what that meant. At the time, it meant nothing to me, but now I realize it's the most important buying opportunity that we can ever come across. Buying the dip refers to buying an asset, which could be a fiat currency like US dollars, could be cryptocurrency like Bitcoin, could be stocks like an Apple or Microsoft, a bond like a treasury bond, or an ETF like VTI, or some sort of index fund or mutual fund, when that particular pricing for whatever that asset is very low, or whatever that security is. In theory, this could even be buying a used car when used car prices are low. But how do we know when something is priced well? One of the best indicators and what people usually look at when buying the dip is the 52-week range. This is a metric that just tracks the highest and lowest prices of an asset in the last year. It's usually going to be looking at a security, but again, could be looking at anything. We could even look at the watch market if we wanted to. If something is at the low end of a 52-week range, it usually means that it's relatively cheap, but anyone who works in finance will tell you that metric is pretty much bullshit. Luckily, this isn't the only indicator that we have. Also really important when buying a stock is the earnings per share. So this is how much the company made divided by the number of shares that are outstanding, the number of shares that exist in the marketplace. And it's typically a marker of a company with good cash flow or financial health. To illustrate this, I'm going to use an example. Imagine you have a successful gourmet cookie shop. We'll just call it Crumb. Because it was very expensive to start, you have two business partners, and you all have equal stake in Crumb. You've decided that Crumb will start with 1,000 shares, and because you each own a third, you each have 333.33 shares. During the year, Crumb brings in $100,000 in revenue. This means your EPS on those earnings would be $100,000 divided by the 1,000 shares that three of you have. So that would be $100 as your EPS, meaning $100 per share. Something you might notice right away when you get into investing is that some companies have hundreds, thousands of shares. This can kind of erode the meaningfulness of EPS. Because there are so many shares and companies can only make so much money, most companies have an EPS of much, much less than $100 per share. So that would be generally pretty high. This means that if a company has an EPS of $100 per share, it doesn't necessarily mean that it's a better company than one with an EPS of something like $10 a share.